All right, so Roxanne writes in wanting to know about bonds. She says, let's see, there it is. She goes, hey, Josh, can you please explain bonds? I have cash in a fixed income bucket in her 401k paying 2.35, which is pretty good. But she's thinking about moving to the Ginnie Mae, VFIIX bond fund, but don't know the ins and outs about bonds. How do you leave? Do you have to leave them until for a certain period of time? When and how do they pay? She's never invested in bonds before because I didn't know how they work. All right, so let's go over this. My man Doug had sent me this about a week or so ago, and I accidentally trashed it. And I was like, oh man, frantic to see this because I want to show it to you. But he trashed it. I mean, I trashed it, and I had to get it out of the trash can. So thankfully I was able to show it. So this is a perfect segue to Roxanne's question. So thanks for sending this to me, Doug. All right, so Doug's got a portfolio of bonds at Schwab, and these two numbers right here. I wonder if I can highlight that. Yeah, there you go, kind of, sort of. The total market value of his bonds is $88,000. The par value is $76,000. So anyone right now will say, the market value is $87,000, $88,000. The par value is $76,000. That means the bonds are trading at $12,000 premium, $12,000 above par value. So 12 divided by 76 is going to be basically a 16% premium above the price, because bonds essentially are at their par is 100. It's usually 1,000, but they for some reason they slice off the last zero. So the par value of a bond is $100, and we can confirm that because there's the average price, 117.41. So we know right now if Doug were to sell this, theoretically he'd get $88,000 for the portfolio, which would be 17% above the par value. Now that sounds good, but the question is, if he wants a similar portfolio, he's got to turn around and reinvest it at $87,000 for a $76,000 portfolio. I mean, there's always a buying and sell side. The buy side isn't stupid. The sell side isn't stupid. They know, hey, if I'm going to sell $87,000 of bonds that are worth $76,000, there's a reason I'm doing that, and the reason is the interest rates have gone down. I'm just going to have gone down, and I'll show you what I'm talking about here in just a second. So remember, so the way you look at it is a bond. Always the par value is always 100. It could be 1,000, whatever the terminology is. In your mind, you think about the bond in lots of 100 or lots of 1,000. And what that means, by the way, that's just one bond. You're not talking about 150 stocks. You're not talking about all lot stocks. You're talking about one bond. That one bond has a par value of $100. All right, or it's truly $1,000, but they say 100. I don't know why. It's going to mature at 100. All right, so we know for a fact the bond is issued at 100, is going to mature at 100. So the bond is just like this. It's issued at 100, matures at 100. Literally nothing could be cleaner. It's that simple. Now, if the bond is trading at 117, what does that mean for the future of the price of the bond? So the bond is issued at 100, it matures at 100, but right now it's trading at 117. What does that mean must happen to the price of the bonds? Well, they must go down. All right, they have to go down. That's all there is to it. Now, they don't have to go down tomorrow. They could even go up. The further they go up, let's say this bond went to 134, the bigger the decline is going to be, because the bond will mature at 100. That's all there is to it. Bonds are issued at 100, they mature at 100. Regardless if the price is 65 today or if it's 135 today, it does not matter. It will always go back to 100, always, because that is what the issuer of the bond will do to get his money back. The issuer says, okay, I'm calling my bond back in. I'll give you $100. We're closing out this contract. It's literally that simple. So what we see right now is some people who don't know better will say, oh man, I'm getting 117. That's a 17% premium above par value. And they think they got a good deal. All I see is that's a 17% loss that you're going to be taking. Literally, that's what I see. I see it's a 17% loss. Doesn't mean it's bad, because that's already factored into the yield. The yield is reflecting of the loss that you're going to take. And I'm going to tell you right now, when you're trading at premium bonds, all right, premium bonds means the interest rates have gone down, which means the coupon rates on these bonds, which I'll prove to you here in just a second, are going to be significantly higher than the estimated average yield that we see today. The coupon rate. So the bond starts at 100. All right, so you got a bond. Starts at 100 and has a 4% coupon. This is the coupon. That means whoever owns this bond is going to get $4 every year. All right. So whoever owns that bond gets $4. That's a 4% coupon on a $100 bond. In 20 years, 10 years, 5 years, whatever, it matures at 100, and the whole contract's null and void. They're done. All right. Now a new bond comes to market, same exact quality, same exact firm, same exact maturity, but it's only paying 3%. All right. So this bond, we'll say, is a 20-year bond, and now this bond is only 15 years before it matures. So a new bond comes around, everything's the same company, same credit issuing. Its par value is 100, is issued at 100, it's going to mature at 100, but it's only paying 3%. And it's a 20-year bond, we'll just say. This bond is par value, was trading at 100, 4% coupon, 100 is a maturity, but it's going to mature in 15 years because 5 years have elapsed. Which one is more valuable? Are you going to pay the same price for a 3% bond that's 20 years removed from maturity as you would a 4% bond that's 15 years removed from maturity? So here you're literally getting a 33% increase in yield for the same risk of the bond for a lesser maturity because it's going to mature in 15 years. Which one is more valuable? Well, inherently this one's going to be more valuable. So you're going to pay more for that bond, and we'll just use the example that Doug's using here. You'll say, when all things being equal, I'll pay $117 for a 4% bond that's going to mature in 15 years. It'll give you the exact same rate when all is said and done. It's just basic math as this bond. You'll pay $100 for a 3% bond that's going to mature in 20 years. I'll pay $117 for a 4% bond that's going to mature in 15. It's just basic math, really. And so when you see these $117, which 100 is a par value, the interest rates have gone down. If you see average price below 100, say 75, the interest rates have gone up. That's all there is to it. So in this case, the bonds that were issued before with higher coupons are more valuable. They trade at a higher price. Doesn't mean anything. It just means you're getting a better coupon, and you're going to lose some of your capital gain. You're going to lose some of your principal. You'll lose 17% in value in order to get a higher coupon. All things being equal, the estimated yield is going to be the same on that 3% bond or that 4% bond trading at 117. I'm telling you, it's just mathematical assurances. There's no difference around that. And here we can see the average coupon rate is 6.25 essentially. So we see the average yield is significantly lower than the average coupon rate. So we have 6.3 years for this right here, this 117 to drop back to 100. It's going to drop back to 100 in 6.3 years because that's the average maturity. The average coupon rate is 6.25, and the average estimated yield is 3.6. And we just, if you've been around long enough, you just know how this works. So you're saying, okay, if the coupon rate is significantly higher than the yield, that means the price is going to be significantly higher than par. And we see this all right here. All right. So at the end of the day, this guy is getting, though, $4,583 of interest, which is significantly more. Let's take a look. He's getting $4,583 in interest on, it was at $87,936. So he's getting essentially 5.2 is his average interest, roughly 5.2. Let's do 4,583 divided by total par value is 6%. So we don't know what he bought it at, but essentially it's between 6% is his coupon, which would equate to that right there, or 5.2% on the total market value is what his interest is getting. So he's getting a decent interest relative to what the yield is paying right here. But at the end of the day, he's paying a premium for it. There's a lot going on in there. I don't want to get too deep in the math because you can look at the math and it makes sense. But in this case, again, average price is significantly higher than the par value, which means the coupon is significantly higher than current yield. All right, so let's go look at the holdings here. This is interesting to me. So he's got a maturity. This is going to mature GE this November. GE 3.65% is a coupon. That was a coupon it had. Now the interesting thing here is a coupon is actually higher right now than the estimated yield. All right, and so but it only has. And it's about 100.468 is the most recent market price because it's going to mature this year. So this isn't really a good example because this is going to mature. So what's happening here is 3.65 is a coupon. Right now the yield is 3%. It's trading at a little bit of a premium, but that will go back. That's not good. Let's look at one that's going to mature here. 2029. Here's a Kroger. Oh yeah, look at this. This is 7.7. Right? So that's a 7.7 coupon. This is going to have a significantly higher price. So let's look at this. Yeah, the price is 35% above par. So this Kroger is 7.7%. That's the coupon you're getting. So if you had this at issuance, it's probably a 30-year bond. It's probably issued in 1999. Yeah, 1999. You're like, I got a 30-year bond at 7.7. You bought it at 100. Well, someone right now is saying, I'll buy that for 135 in order to get that 7.7 coupon. Does that make sense? But if you pay 135 on 7.7, you're only getting an estimated yield of 3.295. Because that 35 you're paying above par is going to go down. You're going to lose that 35. So you're sitting there thinking, I will pay $13,529 for a bond that's $10,000 at maturity. So I'm going to lose 35% of principal in order to get 7.7% of coupon. I hope that makes sense, man. It's tough. This is a tough thing. Don't get on yourself if you don't quite get it. But just remember, if it issues at 100 and matures at 100, if it's trading above or below, that means something has gone on with the interest rates. No one is sitting there thinking they're getting 7.7 for $100. No one's getting that. So to get that, you're going to pay 135. You're going to pay a 35% premium over the par value of that bond because you're getting a significantly higher coupon. But when you factor in the premium you're paying relative to the coupon, you're still only getting a 3.29% estimated yield. That's it. Even though your coupon is 7.7, you had to pay 135 to get that, which means your total yield is 3.95. I hope that makes sense. And so again, going back to this other, I guess I don't know where it's at. Is it back here? Yeah, here we go. So if we go back to here again, we are getting a coupon rate of 6.23, but we're getting a yield of 3.61 because we had to pay significantly more for the value of the bonds. Now I don't know what my man Doug paid for this bond. I don't know. He might have paid $13,000 for a $10,000 bond. He might say, that's fine because I'm getting 3.6 or 3.295. That doesn't seem like a good deal to me, though. That's a 9-year bond at 3. Actually, that's only a 9-year. I don't know what Kroger rating is, Baa1. I don't remember the Moody's ratings anymore. That doesn't seem like a good deal to me. Again, 9 years. I mean, what's CD's doing? I don't know. 3.295 on a 9-year corporate bond, and I can't remember what Baa1 is. That seems pretty low. I don't think I'd buy that. I'm looking at the 10-year. What's the Treasury's doing right now? The 10-year Treasury at 1.7. 30-year Treasury. Oops. Treasury. Whoa, 30-year Treasury at 2.2. Yeah, that's got to be not a great. That can't be a very. That's a 50% increase above a 30-year Treasury. But it's only a 9-year bond. I gotta remember that. So that's 1 year. The 10-year Treasury is at 1.778. That's basically a little bit less than double the 10-year Treasury for the same roughly maturity on a corporate bond that's rated Baa1. I don't know, man. What is Baa1 rating? What is Baa1? Oops. 1 sec. What is Baa1? Let me Bing it. All right, hold on just a second. What is Baa1 rating? There we go. All right, so Baa1 is the 8th highest rating in Moody's, subject to moderate credit risk, considered medium grade, and may possess speculative characteristics. So is medium grade still considered investment grade? I don't know off the top of my head. I'm not gonna. I don't know, man. But I spend that much above par for a bond that's going to net me 3.295 for Kroger. I don't think I would. I don't think it's enough. I don't think I'm getting enough bang for my buck for the risk there. All right, so let's look at another. I mean, discount. We got this one discount bond, and it's 99.439. It's got a coupon of 2 1/8. The yield right now is 2.745, but it matures 12 months from now. you're basically paying a little bit lower than par. I don't know if I mean, for a year, that's probably not bad. When it's GE though, that probably is worth the risk. You're getting 2.75. It does have a call date in September. No, that's your yield. I'm sorry, you're only getting that's your yield. There you go, 2.75. You're paying a little bit below par. GE. I don't see GE going kaput. I hope that might be one that's worth a risk. And again, here's a GE that's 2023. So that's basically has 4 years out. 4% is your coupon. 3.5 is your yield. You're paying just a little bit above par. Yeah, that might be worth it. That's where you're hoping that G doesn't freaking jump the shark. That's for sure. So he's got all these in pretty lower grade bonds. Lots of GEs. Here's the problem. GE goes bankrupt. He's got 3 GEs. Ford's another tough one. He got a Mexican bond. Yeah, that's a pretty tough portfolio. That doesn't look all that good to me, man. You're getting 3.6% yield on a pretty aggressive bond portfolio. With 76,000, well, actually $87,000 at risk. Again, I don't know how much he invested. Let's see what Ginnie Mae is doing. That's what Roxanne. Here's Ginnie Mae. That's what I'm saying. 2.76. So I don't know, Roxanne. You got 2.35 on a guaranteed, basically stable value fund. Ginnie Mae's 2.76. Yeah, I'd do that. I don't know your situation, Roxanne. I'd probably do that. I mean, think about this: 2.76 minus 2.35. That's 41 basis points over 2.35. That's a 17.5% increase in yield. The Ginnie Mae, the fund, the Ginnie Mae is guaranteed. The bonds inside the Ginnie Mae are guaranteed by the Fed, so you know for a fact the bonds aren't going to go kaput. Now, there is a time you could lose some money. Unlike this guy who emailed me the other day, Ginnie Mae, you can't lose money. Yes, you freaking can. You can lose money. I mean, if we just look at, let's see. If you here, a perfect example. If you buy here, you're paying in 2011, you paid $11.18. Come down here in 2018, you're getting $10.05. That's a 10% decrease in price. Now, you can say, yeah, you're getting yield all the time too, but I mean, the facts are, look, you paid right here $11.13. In 2 years is $10.45. You lost money. I mean, it's just I don't get why that guy was saying that. It's weird to me. But it doesn't lose money very often. I mean, let's be real here. Ginnie Mae has lost money, I think, in 2 years or something like that. It's just a great fund. I'm a huge fan of Ginnie Mae fund. It's boring, but that's good. But the issue with Ginnie Mae is you're not getting a big bang for your buck. You're getting 2.76, but it's liquid. It's guaranteed. The bonds are guaranteed by the Feds. The expense ratio is 2:1. It's just a great fund. I'm a big fan of that. And I wouldn't have a problem with that. But I mean, I don't know your situation, Roxanne, so keep that in mind. You know you better than me. This could be the 1 year that Ginnie Mae collapses. I just don't know. I mean, my goodness, who's to say? But could 2.35? I think it'd be worth the risk, but I'll leave that up to you to figure that out. Anyway, I hope this helps with bonds. Be careful with bonds, man. They are a sneaky, sneaky thing. You got to understand them. All right, we'll see you.